If, like the two observers we quoted in our recent article, you believe that we may be headed into a March 2000 or summer of 2008 situation in the market, you might want to consider hedging at this point. Let's look at a way of hedging market risk, assuming you have a portfolio that's highly correlated to the Nasdaq. The first thing we'll do here is we'll pull up the current price of the QQQ ETF, which tracks the Nasdaq 100, and that's $325.31 as of Tuesday's close. Now, let's say you have a portfolio which is worth $500,000. So what you can do here is divide $500,000 by the current share price of the Nasdaq tracking QQQ ETF, which we've already forgotten. So we're going to go back to Yahoo, and you can see again it's 325.31. And that gives us a number of shares rounded up to 1,537. So we take that number and we go to the Portfolio on our iPhone app. And first we enter in QQQ as the symbol. And then I believe that was 1537, but let's double check. Yeah, okay, so 1,537 shares. And then here we enter in the largest decline we're willing to risk in our portfolio over the next, well, we picked that too. Let's say we're willing to risk a decline of 20%, but not one larger than that. You could pick whatever you like here. In fact, why don't we make it 19% to be fancy? And then the next thing we do is we go ahead and pick the time to expiration of the options we're using to hedge. So for simplicity's sake, let's leave it at our default time to expiration, which is the one that goes closest to 6 months out. We tap Find Optimal Hedge. And in a few moments, we're presented with the optimal hedge to protect against a greater than 19% decline in QQQ for 1,537 shares. As you can see here, the cost was $15,855, or 3.17% of position value. The annualized cost was 5.28% of position value. Now, to be conservative, that was based on the ask price of the puts. In practice, you can often buy and sell options at some price between the bid and ask. But let's look at a couple of ways we can potentially lower that cost. One thing we can try doing is rounding up the number of shares to the nearest round lot. That would be 1,600 shares in this case. A couple taps later, and we see the cost has come down slightly to $15,008 per share. I'm sorry, $15,008 for the optimal puts. So that's one thing we can do to lower cost. Another thing we can do is look at different times to expiration. So here, the cost as a percentage of position value is 2.88%. If we go to a shorter time to expiration, that most likely is going to go lower. But to compare apples to apples, we'll want to look at the annualized cost. In this case, it's 4.81% of position value. Let's see what it would be if, instead of going out 6 months, we go out about 3 months. And here, as you can see, the cost as a percentage of position value goes down to 1.16%, and the annualized cost goes down a little bit to 4.24%. So this is something you can play around with depending on when you see or when you expect the risk to most likely happen. Do you expect you'll know within the next few months if we're in a 2008 or 2000 situation, or if you're not sure at all, you may want to lock in a longer time to expiration while the cost is relatively low. Something to consider if you have a portfolio that's closely correlated with the Nasdaq and you're looking to limit market risk.